The United States, a beacon of freedom and opportunity, built on a foundation of democracy and hard work. But beneath this shining facade lies a secret history, a hidden ledger that whispers tales of power, control, and the relentless pursuit of wealth. This is the story of the U.S. banking system, a story that begins with simple bartering and culminates in the enigmatic Federal Reserve, an institution shrouded in mystery and controversy. Our journey takes us back centuries, from the bustling marketplaces of old to the towering skyscrapers of Wall Street, unraveling the evolution of money and the intricate web of power that binds it. Our story takes a decisive turn in the early 20th century with the creation of the Federal Reserve, an institution shrouded in secrecy and controversy since its inception. Born from the ashes of financial panics and economic instability, the Federal Reserve promised to be a beacon of stability, a guardian of the nation's monetary system. But beneath the veneer of security lay a complex and often opaque network of power, raising questions about its true purpose and the extent of its influence. In the beginning, commerce relied on a simple yet often cumbersome system: barter. Imagine a farmer needing tools, forced to find a blacksmith willing to trade his forged metal for bushels of wheat. This system, while direct, was fraught with inefficiencies. Finding willing trading partners often proved difficult, with desires rarely aligning perfectly. What if the blacksmith needed not wheat, but cloth? The emergence of gold as a form of currency marked a pivotal turning point in the history of finance. The Kingdom of Lydia, an ancient civilization nestled in what is now Turkey, first recognized its potential. Gold, with its inherent qualities, provided a solution to the barter system's inherent flaws. Its scarcity ensured value, its durability promised longevity, and its divisibility allowed for transactions both large and small. Now comes the rise of the bankers and the shadow of doubt. The convenience of gold, while revolutionary, also presented new challenges. Carrying large amount of gold proved risky, inviting theft and loss. This need for secure storage gave rise to a new profession: the banker. These early bankers offered a simple proposition: entrust us with your gold, and we will keep it safe, issuing you a receipt, a promise to return your gold upon demand. These receipts, initially simple IOUs, became the precursor to modern paper money. These early banks quickly became hubs of financial activity. Not only did they provide safe storage, but they also facilitated transactions. Instead of physically transferring gold, individuals could now simply transfer their receipts, making trade faster, safer, and more efficient. This innovation further spurred economic activity, allowing merchants to conduct business across vast distances with relative ease. However, this seemingly beneficial system harbored a hidden danger, a flaw that would have profound consequences for the future of finance. Needing help, as America was confronting another financial crisis in 1907, and the United States was the only one of the world's major financial powers without a central bank, the nation was forced to turn to Wall Street. Finance mogul J.P. Morgan, who had bailed the government out of a financial crisis in 1895, organized private sector investments and lines of credit to stabilize the banking system amid its latest panic. Recognizing that the nation could not continue to rely on wealthy individuals to stem an economic and financial crisis, Congress passed the Aldrich-Vreeland Act on May 30, 1908. The legislation provided for the issuance of emergency currency, and from this, the mighty monster continued to grow. The birth of a giant, the Federal Reserve. The year is 1913. The echoes of financial panic still reverberated through the nation. The American economy, much like a ship caught in a storm, tossed and turned with each passing financial crisis. The need for a more stable and resilient financial system had become painfully clear. It was from this cauldron of economic turmoil that the Federal Reserve System, often simply called the Fed, emerged. Created by an act of Congress, shrouded in a veil of late-night negotiations and political maneuvering, the Federal Reserve was presented to the public as a solution to the nation's monetary woes. Its mandate to provide a more elastic currency, regulate banking practices, and prevent future financial panics. The invisible hand, shaping an economy. The Federal Reserve's influence on the American economy is subtle yet pervasive. Like an invisible hand, it guides the flow of money, affecting the lives of every citizen, often without their conscious awareness. Through its control of the money supply and interest rates, the Fed attempts to steer the economy towards a delicate balance, promoting growth without triggering inflation, curbing excesses without stifling investment. But under the guise of good, the harms have crept from beneath. A nation in debt, the price of freedom. The creation of the Federal Reserve coincided with a profound shift in the American relationship with debt. Prior to the Fed, the U.S. government generally avoided taking on large debts, adhering to a philosophy of fiscal prudence. The establishment of a central bank, with its ability to create money and facilitate borrowing, changed the game. The government now had access to a seemingly endless supply of credit, allowing it to finance wars, social programs, and infrastructure projects on an unprecedented scale. This newfound ability to borrow, however, came at a price. Interest rates for every penny borrowed slowly brought families into personal debt. In addition, the national debt began to climb, slowly at first, then with increasing speed. Every dollar borrowed from the Federal Reserve, while technically a debt owed to itself, represented a claim on future tax revenue. Taxes that we the people are left to pay. Whispers of conspiracy, doubts, and dissent. From its inception, the Federal Reserve has been a lightning rod for controversy. Its very existence as a privately owned entity entrusted with controlling the nation's money supply has fueled suspicion and distrust. Some firmly believe it is unconstitutional that money is not printed by our own treasury, but rather, it is printed by a private bank. Critics, from across the political spectrum, have raised concerns about the lack of transparency in its operations, the potential for conflicts of interest, and the undue influence of private banking interests on public policy. The price of progress taxes and the Federal Reserve. As the United States entered the 20th century, a new era of progress and prosperity beckoned. But this progress came at a price increasingly borne by the American taxpayer. The creation of the Federal Reserve, while intended to stabilize the financial system, also paved the way for a dramatic expansion of government power and a corresponding increase in the tax burden on its citizens. We are left paying this manufactured debt, and as continues to grow today. The social contract, Social Security, and the promise of a safety net. The Great Depression of the 1930s shook the foundations of American society, leaving millions unemployed and desperate. In response to this unprecedented crisis, President Franklin D. Roosevelt launched a series of ambitious programs collectively known as the New Deal. The Social Security Trust Fund was created in 1939 as part of the amendments enacted in that year. From its inception, the trust fund has always worked the same way. The Social Security Trust Fund has never been put into the general fund of the government. However, the government has been allowed to borrow from it, still owing $2.7 trillion to the SSA, as of 2022. Among these programs, Social Security stands out as a landmark achievement, promising a safety net for the elderly, the unemployed, and the disabled. But is it really the glitter and gold it was made out to be? The illusion of security debt, inflation, and the erosion of purchasing power. The Federal Reserve's ability to create money, while touted as a tool for economic stability, comes with a hidden cost: inflation. Inflation, simply put, is a decrease in the purchasing power of money. As the money supply expands, each dollar in circulation becomes worth less, eroding the value of savings and diminishing the purchasing power of consumers. A house of cards, fractional reserve banking, and the risk of collapse. The modern banking system, with the Federal Reserve at its helm, operates on a principle known as fractional reserve banking. This system, while seemingly complex, rests on a simple and inherently risky premise. Banks are allowed to lend out more money than they hold in reserves. Imagine a game of financial Jenga, where each block represents a loan, built upon a foundation of actual deposits. The higher the tower rises, the more impressive it seems, yet the more vulnerable it becomes to a sudden collapse. War, a tragic and recurring feature of human history, demands vast resources. men, material, and, above all, money. The Federal Reserve, with its ability to create credit, has played a pivotal role in financing America's wars, from World War I to the ongoing conflicts of the 21st century. For 2023, the average taxpayer will have contributed $5,109 to militarism and its support systems, including war and the military, homeland security, federal law enforcement, and veterans programs. The biggest portion of that tax bill is for the Pentagon itself, at $2,974. This ability to fund military adventures through debt and taxation has profound implications for both domestic and international affairs. The Federal Reserve, with its immense power and opaque operations, has long been a target of suspicion and conspiracy theories. These theories, while often dismissed as the ravings of fringe groups, tap into a deep-seated distrust of centralized power and the belief that unseen forces manipulate events for their benefit. The Federal Reserve, despite its power and influence, operates largely outside the realm of public scrutiny. Its decisions are made behind closed doors, its inner workings shrouded in secrecy. This lack of transparency has fueled distrust and suspicion, leading to calls for greater accountability and reform. The 21st century has witnessed a profound transformation in the nature of money itself. The rise of digital technologies, from online banking to mobile payments, has gradually reduced our reliance on physical cash. This digital revolution, once confined to the periphery of the financial system, has gone mainstream, challenging the very foundations of traditional banking and monetary policy. Too big to fail. The moral hazard of bank bailouts. The 2008 financial crisis, triggered by the collapse of the subprime mortgage market, exposed a fundamental flaw in the global financial system, the problem of too big to fail. As banks and financial institutions grew larger and more interconnected, their failure posed a systemic risk to the entire economy, leading governments to bail them out with taxpayer money, a move that sowed the seeds of moral hazard. The global gamble and systemic risk. The 21st century financial system is a global casino where money flows across borders at lightning speed, and events in one corner of the world can trigger shock waves that reverberate across the globe. This interconnectedness, while facilitating trade and investment, also creates new vulnerabilities and amplifies systemic risks. The future of money: decentralization, innovation, and the quest for a more just financial system. The future of money is a canvas upon which visionaries, innovators, and reformers are painting bold new possibilities. The old paradigms of centralized control, opaque institutions, and exclusive access are being challenged by a wave of technological innovation and a growing demand for a more just and equitable financial system. The unfinished story. The U.S. banking system, a complex tapestry woven from threads of ambition, innovation, and power, continues to evolve before our eyes. From the early days of simple transactions to the sophisticated financial instruments of today, the journey has been nothing short of remarkable. Yet, as we have seen, this pursuit is not without its perils. The history of banking is replete with examples of financial crises, from the Great Depression to the 2008 financial meltdown. These events serve as stark reminders of the fragility of our financial systems and the importance of vigilance and regulation. The concentration of power, the allure of easy credit, and the ever-present risk of instability remind us that the quest for a just and equitable financial system is an ongoing struggle. The power wielded by the big private banks can have far-reaching consequences, influencing everything from individual livelihoods to global economies. It's time for America to wake up to the truth. Thanks for watching. Please subscribe for more thought-provoking content.